Reading price action is one of the most important skills that you could develop as a trader. Welcome back to the Zero to Hero series, where we take you from an absolute zero to put you on your way to becoming a hero in these markets. Today, we'll be going over episode 2, breaking down how we go about reading price action. How price moves. The way in which price moves in terms of aggression tells us a lot. So, what we're typically looking for in terms of high probability trading, we want to see larger expansion moves, broad candlesticks with minimal back and forth. We use conditions in conjunction with time of day to determine if trading will be favorable for the session. We specifically look for high probability times to trade before ever placing a trade. Not every day is a trading day. By avoiding these muddy waters, we're able to have a higher baseline performance than the average trader. So, what defines expansion? When we're thinking of expansion, we want to be thinking of candlesticks that are broad without any overlap to the left and right. This is also referred to as displacement. You will commonly see these referred to as fair value gaps as well. So, displacement is our secret to knowing whether we are in high probability conditions or not. If we see no displacement, we can understand and assume there's no real participation. Relying on displacement among a few other key variables is the start to effectively reading price charts. Market structure shifts are one of the ways that we can identify price reversals. These often create a trading opportunity. Now, a market structure shift occurs when a swing high or a swing low is broken with a displacement. As you can see here, we have an example of a swing high, which we discussed in the last episode, that 3-candle pattern, being broken with what we see is a displacement, creating a fair value gap at the same time. The key to identifying high probability structure shifts, it involves a strong displacement that closes above or below the swing high, or if we're looking at a short, under the swing low. Displacement is our way of seeing one-sided conviction within a market. Animation like this gives us a clue. It tells us that there is an interest in price going one way more so than the other. We specifically want to see this type of action as a reaction to an important level. So when we see an old high or an old low being taken, that's when we typically would like to see a displacement. As traders, we always want to find volatility when entering the markets. Idle action is going to lead to excessive losses. We want to avoid action and price where it tends to go back and forth. So when we pair this with the concept of liquidity sweeps that we discussed in the last episode, we can begin to form a high probability trade. The failure to sustain a break above a level or below a level gives us a solid context to begin to look for entries. If we align our entry against a sweep on liquidity, we have a strong counterparty in that trade. There's losing traders on the other end. And what we do is after a sweep, we look for an entry on a lower time frame. That's where we begin to zoom in on the lower time frames. Consolidation is what we can consider a lower probability time of day. It is typically non-directional, and for new traders, it can lead to excessive losses. This is where price is basically swiping back and forth without really accomplishing much. Consolidations typically occur when the market needs time to recharge between expansion moves. And as you can see, there's an example of what a consolidation might look like. So for this metaphor, I want you to think of consolidations like traffic. Sure, you can drive during traffic hour, you'll eventually reach your destination, but you might be late. So when we're thinking of expansions, that's like taking a trip in the middle of the night. When there's no one around, pretty easy. You get there with no hesitation. With this in mind, we want to avoid those crowds. So we typically want to align with expansion phases when trading. Moving into time of day, there is specific tendencies during specific times of day. We will rely on these to build a reliable trading model. For our future discussions, we will be focusing on trading the New York Open between 8 a.m. and 11 a.m. Eastern. The element of time will help us avoid shifts into consolidation. We want to look to capture the most volatile time of day, and then we want to move on with our day. We don't want to be stuck to these charts. Our goal is to be in and out, get the most for what we can, and keep it moving. So to recap, we want to consider market structure shifts as a potential sign for reversal. These are the most crucial when they are paired with an important level, such as an old high or an old low that has been swept. If we see a market structure shift that forms after that, we can expect a high probability trade. We also want to be thinking about markets in terms of displacement. When we see large volatility in one direction, these broad expanding candles, we can understand that price is waking up. We also want to consider the concept of liquidity sweeps when we're reading price action. Runs above old highs or under old lows are a key indication that a high probability trade is likely to form afterwards. So, in the next episode of this series, we will be going over how to accurately build a trading model and use real life examples when doing so. We will be on the charts. We will be going into price action specifically, incorporating all of these topics that we've discussed so far up until this point. And we will finish this series by having a live execution trade using everything that we discussed. So, hope you got something out of today. Please be sure to leave a like, comment, subscribe, do your thing. Until next time, we'll see you later.